Hello and welcome back. In this video, I want to talk to you about backtesting, particularly a common mistake that people often make when they're backtesting a trading strategy. If you don't already know what backtesting is, well, typically you might have a trading strategy, a method or a system with rules to get you in and out of the market. And what backtesting does is it allows you to bring up your charts. We all know how to bring up charts and look back over some past data and test, see how it works. I've been doing quite a bit of that recently. It's something I offer as a service now. People come to me with their ideas because I use a charting software, a backtesting software. I use Multicharts and I can program it. So I can program it and get some really detailed reports. But anyway, I wanted to make this video as some little tips to you to show what this one silly little I wouldn't say mistake, but an oversight perhaps. If you don't include this in your backtest, then what you could be doing is you could be taking a strategy that looks really good in a backtest, looks like it's going to make you a lot of money, but when you actually come to trade it in a real live account, will actually do the complete opposite, just be a money losing strategy. And it's a really simple little thing. What I'll do is I'll take you over to my computer. We'll look at the software that I'm using and I'll show you the before and the after effects of what happens when we overlook this little parameter. So we go over there now. It's actually a type of video that I put together for one of my private coaching clients, and it just thought about it the other day. I thought this is something that could really help a lot of people just to overcome. So let's go and have a look at it now. Here we are then. What we're looking at is a chart, a 60-minute chart of euro yen and a strategy that I've prepared for this demonstration, if you like. We're in Multicharts. That's what I use for programming, testing, trading, automated trading. It does all of that. And we're going to look at the back test. It's on average takes a couple of trades every day. There's going to be over 6,000 trades in this back test. So first of all, we'll look at the equity curve to see how this strategy may perform. And there's the equity curve. The little green dots, they mark new highs in your equity. So ideally, the more green, the better, because you're constantly making new highs, and less drawdown, that sort of thing. So it looks a reasonable equity curve going back from 2008 right up until almost the end of 2019. So yeah, over 6,000 trades. So that looks good on the surface. If you'd been presented this equity curve by a strategy vendor maybe trying to sell you the strategy, then you might think, yeah, that looks great, can't go wrong. So now let's do what the demonstration was about. What I'm going to do is I'm going to add in some costs. Now there always is going to be costs to trading. And with Forex, it could be just a spread, but quite often not. There's commissions as well. But not only that, there's also things like slippage and bad fills, mistakes. So, in real term trading, you're always going to be a lot worse than what the backtest looks. So we can account for that somewhat. So we can add in some costs just in the software. And what I'm going to do is I'm going to add in just a very small amount of pips. I'm going to add in about couple of pips to get in the trade, maybe a couple of pips to get out. So total of 4 pips per trade, which euro yen, the spread just a little bit larger than that, the likes of euro dollar. Depending on what time of the day you trade, the spreads could be larger. But just as a bit of a demonstration, 4 pips isn't well out of the normal realm of things. So we'll add in that now. And wait for the strategy to calculate, and then we'll have a look at see what the changes are in the equity curve. So this is just 2 pips in and 2 pips out. Whoa, and look at the equity curve now. It's almost kind of turned it upside down. It's gone from what looks like a lovely, smooth, uptrending equity curve that everybody might like to trade to something that is just money losing the whole way, flat in periods at best. So that's the effect of just a very small amount of cost, which you are going to be subject to going forward live. This is why it's so important to understand how to backtest correctly, how to work out what the backtest is going to look like going forward once we're subject to real live costs. So there you have it. You've seen it on the charts, seen it in my software. Just that couple of pips of spread in and out of a trade can make a massive difference. Turn what looks like a good winning strategy, something you might have picked up or maybe even paid for. You don't know how they might have tested it. They may be showing you an equity curve before costs, but once you've added in some costs, it can really turn what looks great into something that looks really bad, and essentially going forward is going to be a money losing strategy. Once you get experienced in backtesting, you'll understand some of these ways that you know what looks good in a backtest, how it will replicate going forward with real money. So I hope that helps. One little tip. If you've got any questions about backtesting or any other parts of trading, or maybe you've got a strategy that you want programmed and tested on a decent amount of back data and you want a report done, you can contact me. Go and visit my website. It's thetransparenttrader.com, and please subscribe to this video, this channel, like the video, and I'll see you in the next video.